Morgan.
Okay. Pippa Stevens, thank you. It looks like we're down about 6.5% now and falling. Now let's get to today's market action, and there was a lot of action as we await Tesla results. Let's bring in Carson Group Chief Market Strategist Ryan Detrick and Payne Capital Management Senior Wealth Advisor Courtney Garcia, along with CNBC's own Senior Markets Commentator Mike Santoli. Great to have you all here on a day where there's a lot of green on the screen. Ryan, I'm going to kick this off with you. It looks like more than 1,000-point gain here in the Dow. Everything's up more than 2.6%. The NASDAQ, the Dow, the S&P. Are we testing and bouncing along bottoms here for stocks? Or is this really just a knee-jerk reaction after all the selling we've been seeing?
Well, first off, thanks for having me back, and thanks for having me today versus yesterday. It's a little more exciting to talk about today. We think we are trying to carve out that low. Everyone. I was trying to think of some different things I could talk about. You've had some great guests on today. One thing that's really caught our attention. If you look at like an advanced decline line, a cumulative basis, how many stocks going up versus down. Keep this real simple. The advanced decline on the S&P 500 is virtually flat the last couple months, right? We know price broke down below the December lows and the January lows. So it's telling us, under the surface, things are actually holding up good. And I get it. Well, of course, the market's not holding up good. We're still down 10% on the year. But these are some positive things. 9 of 11 sectors are outperforming the S&P 500 on the year. We get it, right? Tesla, the technology, some of those big names are really, really lagging, pulling the market down. But honestly, when you look at it, the Globe ex-US is up 6% on the year. I mean, if you have a diversified portfolio, last comment on this, we've said, this year is a big one about, when in doubt, diversify it out. The models we run for our Carson partners, we were very heavy U.S. last couple of years. We've been definitely more diversified. We still have equities, yes, but around the globe, things are doing okay. We're optimistic the U.S. is going to play catch up with the rest of the globe here before this year is all said and done, but we think we're trying to carve out a low here.
Courtney, we know trade headlines are moving the markets in either direction. Today it was reported headlines that CNBC helped report from Treasury Secretary Bessent regarding China and trade dynamics there. But earnings season is also very much underway, and some of the biggest movers we've had, including today, I think about 3M, for example, a multinational manufacturer that I think a lot of folks were nervous about going into the print because of trade dynamics, putting up stronger than expected results. How much now hinges on earnings?
Yeah, and I think tariffs have been moving markets more so than earnings because all of these companies are really just in a standstill. They don't really know how to react to these tariffs yet because they've been put on hold for 90 days, but they don't know, are they going to be the 10%? Are they going to be higher? Are they going to come back on? For which industries is that going to come on for? There's still so much unknown. And that's really when you're looking at guidance moving forward, there's kind of a lot that's unexpected. So it's really tariffs. And if we do start to see some de-escalation with the U.S. and China, and that's what you were seeing headlines on today, that is a much more positive for the markets and any companies who are at risk of these tariffs more so than others. If we can start to put that capital to work, if we have some sort of certainty that we can start making some business decisions, that would be a much better thing for the markets moving forward.